One topic which has always been a matter of concern for the students of class 12th in business studies is trading on equity. Undoubtedly, many students raise their concern related to this topic कि concept को apply कैसे करना है, numerical को कैसे solve करना है. So I am making this little effort here, hoping that it will help the children in understanding the concept. First, we'll recall what we had done in class 11th. We had identified that there are two primary sources of finance for any business. One is own source, other is borrowed source. In own source, we talk about equity. When we talk about equity shares, we know that the dividend is paid on the equity shares. Payment of dividend is not compulsory. Also, the amount of dividend paid is not treated as a tax deductible expense. Now, coming to debt capital, interest is to be paid on debt. Payment of interest is compulsory, regardless of the profits of the company. Also, the amount of interest paid is treated as a tax deductible expense. To understand the concept of trading on equity, let's talk about a company. Say the company's name is AB Limited. The total capital of the company is rupees 30 lakhs, which has been raised by the company through a combination of equity and debt. 20 lakh rupees have been raised through equity and 10 lakh rupees have been raised through debt. Now, how this 20 lakh rupees amount has been aggregated is the company has issued 2 lakh equity shares of rupees 10 each. Now, whenever the company is making an investment of 30 lakhs, it is doing it in pursuit of making some earnings. In this case, let's presume the rate of earnings is 20%. That means on the capital of 30 lakhs, the company has made a profit of 6 lakhs. Now, coming to the circle, we'll try to understand the division of this 6 lakh on diagrammatically. Let's assume that the total earnings of the company before interest and tax is rupees 6 lakhs. So that means the circle is representing a value of rupees 6 lakhs. The first thing that the company has to pay out of its profit is interest. Now, in this case, the debt raised by the company is rupees 10 lakhs. So, we will be calculating 10% of 10 lakh, which is going to be 1 lakh. Now, out of this 6 lakh rupees, the company has paid 1 lakh rupees as interest. Now, the company is left with 5 lakhs. 6 lakhs minus 1 lakh. Now the company is left with rupees 5 lakhs. Now the next deduction which will be there is tax at the rate of 50%. So now 50% of 5 lakh is rupees 2 lakh 50,000. So now the company is going to pay a tax of rupees 250 lakhs. Now whatever is remaining after payment of interest and tax is assumed to be distributed among equity shareholders. So that amount is called dividend. So when we talk in very simple manner, what is dividend? Dividend is that portion of the total profits of the company which is being given to the shareholders. Now, how is the dividend being calculated here? See, we had 5 lakh. Out of this 5 lakh, rupees 2.5 lakh is going as tax. So we are left with rupees 2 lakh 50,000. That is what we have taken here, 2 lakh 50,000. And even if we try to, just calculate and check, is the total deductions coming out to be 6 lakhs? 1 lakh is here, 250 is here, another 250 is here. So total amount is 6 lakhs. Now, how is the dividend divided? Let's assume that there is a lady and she has got 10 sweets with her and she has 5 little children and she decides to give equal amount of sweets to each one of them. So each child is going to get 2 sweets. Similarly, the company has 2,50,000 rupees to be distributed and the number of shareholders is 2 lakhs. So when we divide, similarly, like we divided 10 by 5 and it was coming out to be 2, here we are dividing 2,50,000 by the number of equity shareholders, which is 2 lakh. So the amount is 1.25 per share. So what does this mean? Suppose there is a person who is holding 100 shares of AB Limited. So the dividend per share is rupees 1.25, which is going to be rupees 125 per share. So that is the dividend. This is how the distribution of the profit is done. This is the core basic fundamental understanding to further understand the concept of trading on equity. I hope it is clear. When we talk about trading on equity, we broadly divide the concepts which are tested or the type of numericals that you get in the paper into four categories or four cases. So first we begin with the case 1. Now let's take up an example here. A company wants to raise a total capital of rupees 40 lakhs. The finance manager is considering two options. The option 1 is that he is going to raise the entire amount of 40 lakhs through equity share of rupees 10 each. So as you can see in this case, there is going to be no amount of debt which is coming in. The entire amount has been raised through equity. In the option 2, he plans to introduce a debt component of rupees 10 lakh. Again, the total capital is rupees 40 lakhs. The other details which have been provided are that the rate of interest is 10%, the tax rate is 50%, the return on investment is 30%. So the question that you are asked in exam is which of the two options should he be selecting? Now in this case, the first thing that we'll be doing is we'll be calculating the return on investment, which is 30% as it is given in the question here. It is 30%. So we calculate 30% of 40 lakh, which is our total capital, and it comes out to be rupees 12 lakhs. Now, in how exactly, if you can recall the circle, total capital, earning before interest, this is where that circle began from. And the first thing that we had made cut in the circle was interest. Then the next thing we had made was this was the interest. Then we made another deduction there, which was tax, and then we calculated EPS. So we are going to move forward in the similar manner to solve this. Now in the first case, the equity shares is rupees 40 lakhs. Debt is nil. Total capital is 40 lakhs. Now, when we look at earning before interest and tax, that is what we have calculated as 12 lakhs, which is the value of the complete circle in this case. Now, since there is no debt, the component of interest is also missing. So, just because there is no deduction, the earnings after interest and before tax is rupees 12 lakh only. Now after this we will be deducting the amount of tax. Here it is 50%. So it is minus 6 lakhs. So now we are left with 6 lakh rupees. Now this 6 lakh rupees is our sweets. And what is the number of equity shares? This is what we need to see. The company has a total capital of 40 lakhs and the value of one share is rupees 10. So that means the company has issued 40 lakh divided by 10, which is equal to 4 lakh equity shares. So that is what we are going to write here, 4 lakh equity shares. Now to calculate EPS, we have to divide 6 lakh by 4 lakh. This is the sweets and this is the number of children. So we divide 6 lakh by 4 lakh and we get EPS as 1.5 or rupee 1 rupee and 50 paise. Now we go further and we try to work out the option 2 here. The equity share capital is 30 lakhs, debt is 10 lakh. So it's already given in the question. We are taking from here only. Total capital is 40 lakhs. The ROI will remain same, which is 12 lakhs. The interest is going to be rupees 1 lakh in this case because the company has issued a debt of 10 lakh rupees at the rate of 10%. So that is reflecting here as 1 lakh. Now we'll minus 12 lakh minus 1 lakh, which is going to be 11 lakhs, which is our EBAIT, earning after interest before tax. Now we'll be deducting 50% tax from here, which is 5 lakh 50,000 or 50% of 11 lakh, and we are left with 5 lakh 50,000, which is again our sweets. Now what is the number of shareholders here in this case? The company has a share capital of 30 lakh and the face value of each share is rupees 10. So the number of shares is going to be 3 lakhs in this case, and the earning per share is going to be 1.83. Now let's try to understand the concept of trading on equity with this example that we have just now worked out. The concept of trading on equity says the EPS or the return to the equity shareholders will increase, like here it has increased. When will it increase? When the company will use a source of finance which carries a fixed charge, like here debt carries a fixed charge, the rate of interest is fixed. Like here there was no debt, here there is a debt which is there, so the company has included a source of finance in its capital structure which carries a fixed charge. When we look at these two examples and we compare, the earnings we are presuming to be same. The rate of tax is same, but the amount will vary because of the calculations. So this is what trading on equity means. That increasing the return to the shareholders by including a component in its capital structure or using a source of finance which carries a fixed charge, like debt which carries a fixed rate of interest. The definition of trading on equity says that trading on equity refers to an increase in the earning per share by employing. Instead of employing, we can also write by using or by adopting or including by using if you want to make it simpler. The source of finance carrying a fixed financial charge like debentures, which carries a fixed rate of interest, or preference shares which carry a dividend is paid fixed rate of interest on fixed rate of dividend payment, which we have done in class 11th, where we would always write 10% preference shares. So when the company is issuing preference shares, that time only the buyer knows that he is going to get a dividend of 10%, although the payment of dividend is not compulsory. So there are two conditions also that you need to be learning. First is the amount of interest paid should be treated as a tax deductible expense for computation of tax liability. And secondly, the rate of return on investment should be greater than the rate of interest. So here the return on investment was 20% and the rate of interest was 10%. I'm sure this condition is clear to everybody. I'll just take up the example again to explain this particular point. Now let's try to understand what does the term tax deductible means. Like when we talk about the case 1 or the option 1, there is no interest, so the interest deductible point does not arise, so we will be considering option 2. Now, as we had learned earlier, this is our circle which is representing our total profit. In this case, the total profit of the company was rupees 12 lakhs. Let's change the color, and here out of this 12 lakh which the circle represents, the company has paid 1 lakh rupees as interest. So now after that we are calculating tax at the rate of 50%, which was given here, and we are calculating this tax on 11 lakhs. So that means the total profit is 12 lakh, but we are calculating tax on rupees 11 lakh. That means 1 lakh which has been paid as interest. It is exempted from tax payment. This is what it means, that the amount of interest paid is treated as a tax deductible expense for calculation of tax liability. I hope it is clear to everybody. As I have told earlier, there are 4 cases about trading on equity related numericals. We have completed case 1 today and also understood the concept of trading on equity. We will be taking up the other cases in the next video. Thank you.